Mortgage rates are sitting around 6.75 this morning, but here's what's interesting. Jobs are cooling, inflation is improving, and housing activity has slowed. Those are all things that should be helping mortgage rates. So why haven't we gotten the move lower that buyers have been waiting for? And what could that change be next? So here's what you need to know. First, inflation. This week, we got the Fed's preferred gauge of inflation, PCE, which came in basically as expected. Core inflation is still running at 3.3% year over year, but underneath that headline number, the picture gets more interesting. The Dallas Fed trims means measure, which removes some of the biggest price distortions, is running at just over 2.3% year over year. So inflation is still above target, but it doesn't appear to be as widespread throughout the economy as initially thought. Then, of course, we've got employment. Hiring has slowed considerably. The July jobs report was weak. ADP continues to show softer hiring, but layoffs remain effectively relatively low. I've been calling this a low hire, low fire labor market. Again, that's something that should be supportive of lower rates. So why are mortgages still sitting around 6.75 is the big billion-dollar question. Because the Fed doesn't directly control mortgage rates. The long-term bond market does a lot of the heavy lifting. And those investors aren't just thinking about inflation or what the Fed does next. They're also thinking about oil prices, government borrowing, treasury supply, economic growth, and how much return they need to lend money for a longer period of time. And that's really been the battle, something I repeated and shared last week as well. We actually, though, saw this week the 10-year treasury finally make some meaningful progress lower, but haven't gotten the clean breakout we've been waiting for. So I would describe the setup this way to our clients. The conditions for lower rates are improving. The breakout just hasn't happened yet. And now the next major test. Later this morning, Fed Chair Warsh speaks at Jackson Hole. There are a number of Fed officials arguing that inflation is still hot and rates should move higher. Others are looking at a weaker employment and improving inflation, underlying inflation, and questioning whether additional tightening makes sense. We'll find out shortly what Warsh has to say, but here's the takeaway if you are buying or selling a home. Don't try to perfectly time mortgage rates. If you've been sitting on the sidelines, this is really a good time for you to know your numbers and be prepared. Because if rates do make a meaningful move lower, your payment gets better. But you may also have more buyers competing for the same house. The buyer who is prepared before rates has options. The buyer who waits until rates improve, have more competition. As always, I'm Eric Bibel. I bring you this update every Friday. If you like, please like, subscribe, comment, share, get this message out to as many people as possible. Thank you, and let's make it a great day.